Welcome back to Investing Talk Podcast.
Today, we're looking at Tesla.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Let's do it.
The way you have to see this, really, is we're analyzing Tesla not just as a cyclical EV company.
Which is how most people see it, right?
Yeah.
Just a car maker.
Exactly, the common view. But the real story, the one the market is pricing in, is a massive scale growth story. It's underpinned by this emerging optionality in AI, energy, and robotics.
Okay, that's the core shift in the narrative then.
It is. It's the only way to really understand the valuation.
Okay, so let's unpack that.
Yeah.
If we're moving beyond just selling cars, what are the first signals, in the financials right now that tell us this is happening?
Well, it really starts with the balance sheet. Management treats it like a strategic asset.
How so?
They've historically maintained a position of net cash or very modest net debt.
Which gives them huge flexibility.
Huge. And that liquidity is key because management's priority is just aggressive reinvestment. It's a feature, not a bug, as they say.
A feature, right. They pour it back into those future growth platforms.
Precisely. But for the clearest signal of diversification, you have to look at the energy generation and storage segment.
The energy business.
Yeah. I mean, this is scaling, and it's scaling rapidly. In 2025, it already accounted for over 12% of total revenue.
12%. So it's not a side project anymore.
Not at all. It's a material part of the business.
Okay, so this is where it gets really interesting for me. How fast is that energy side actually growing? And what's the driver?
The growth is pretty phenomenal. Storage shipments were up something like 59% year over year.
59%, wow.
And multiple analyses are suggesting that energy revenue could potentially double next year.
Double. What's behind that kind of acceleration?
It's not just residential installations anymore. I mean, that's part of it. But the big driver now is the massive demand for megapack capacity.
The utility scale batteries.
Exactly. And it's specifically tied to powering all these new AI data centers.
Ah, so it's a picks and shovels play on the AI boom.
You've got it. So we're seeing revenue growth driven by something completely different than vehicle sales. That structural change protects them during the auto cycle slowdown.
That's a powerful piece of diversification.
It is. And even with profitability getting squeezed, their production scale, their low working capital intensity.
Right, because the direct-to-consumer model.
Yes, that DTC model means they get cash up front. It all supports robust free cash flow, which they just pump right back into building more capacity. Texas, Berlin, Shanghai, megapack factories. It's a self-funding machine.
Okay, let's shift back to the core then, the vehicles. We know the auto market has been tough.
Yeah.
What did the recent delivery numbers tell us, and what's happening to those margins?
Well, first, the unit demand, it actually remains really resilient.
So people are still buying the cars.
They are. In Q3 2025, they produced over 447,000 and delivered nearly 497,000 vehicles, both record levels.
And what was revenue?
Analysts were looking for around $26.3 billion for Q3, so it confirms they are growing even through this EV down cycle.
But the challenge everyone's talking about is the margin compression.
That's the challenge, yes. The automotive gross margin, if you exclude the regulatory credits, has dropped, significantly.
How far?
From over 25% in 2022 to roughly 16% recently. That's a dramatic cut. It's largely due to the price wars.
16%. That sounds concerning. What's the counter-argument for why this isn't a long-term problem?
There are two main things. First, even at 16 to 18%, they are still solidly profitable. Most of their EV peers are still losing money on every car they sell.
So they can withstand the pain longer.
They can. And second, their structural cost advantages are still there. The gigapresses, the highly automated factories, the vertical integration.
Which lets them cut prices.
Yeah. It lets them cut prices aggressively, basically squeezing out weaker competitors, while they themselves stay in the black.
But some analysts see this as more than just a price war. They see it as a deliberate strategy.
Yes, exactly. The view is that they're trading lower hardware margin today to aggressively grow the fleet.
And the data pool.
And the data pool. That's the crucial part. That data is what fuels the high-margin software revenues that come later.
That is the strategic angle.
Yeah.
But the competition is real. We've seen news about global giants, even Chinese OEMs like Geely building massive new crash test facilities.
So the competition is intensifying, absolutely. In price, features, safety, you name it, But the company still retains that first mover advantage in global EV scale, the
Right.
supercharger network, and critically,
The software?
the software maturity and the AI data ecosystem.
And that's where the real moat is.
The true moat is multi-layered. It's way beyond mechanical engineering. It's the vertical integration of the AI stack, the FSD software, the custom Dojo supercomputer, the data from millions of cars,
And you over-the-air updates.
and the OTA architecture. It's a combination that's very, very hard to replicate.
So if the valuation is really about that, what are the big multi-year plans that fundamentally change the whole equation?
There are three major future levers. You've got volume, mobility, and robotics.
Okay, let's start with volume.
The long-term goal is 20 million vehicles per year by 2030.
20 million, that's an astronomical number.
It is. To get there, they're planning a new, low-cost compact vehicle, the Model 2, let's call it, targeting under $27,000 for late 2026.
Which massively expands their addressable market.
Globally, yes, but that's still hardware.
Right, that's the massive volume expansion. But what about the high-margin revolution?
That brings us to mobility, the dedicated robotaxi platform, the Cybercab.
And the target for that is?
Pilot operations in 2026 at level 4 autonomy. This is the pivot. It transitions them from selling a car once mobility as a service,
Which generates revenue constantly.
and at much, much higher margins, it could generate earnings far beyond what current models are predicting.
And the final piece, the most speculative one.
Robotics. The concept of Optimus, the humanoid robot, this is the speculative capstone. This shifts the moat completely away from traditional automakers.
Because their core skills are mechanical, not digital.
Exactly.
What's fascinating here is the global electric mobility market is projected to hit almost $2 trillion by 2034.
A staggering number.
Growing at, what, a 35% CAGR? These AI and robotics bets are designed to capture the highest margin slice of that whole boom.
That's the bull case in a nutshell.
Okay, let's look at the market view. Technically, where does the stock stand?
Technically, it's seen as consolidating right now. It had that steep derating because of the margin compression we talked about. It often acts as a kind of high beta growth or AI proxy within the Nasdaq.
And what's the money flow telling us? Is the market euphoric or skeptical?
I'd say sentiment is balanced, but opportunity rich. It's definitely moved from euphoria to a show me stance.
So the easy money has been made.
For now, yes. You see some institutional de-risking, Cathie Wood selling some shares amid the AI bubble debates. But the core structural institutional ownership is still there.
So the consensus is cautious.
Very cautious. They see the upside if the AI execution works, but they're pricing in the near-term margin pressure.
Which means expectations are reset.
Mm-hmm.
And that creates room for upside surprises.
Exactly. If margins stabilize or they hit a new FSD milestone, there's room for the stock to run.
What are the immediate catalysts investors are watching in the next few months?
The most immediate will be the Q4 2025 deliveries and earnings.
What will you be looking for there?
The market will focus on how effective the Model-wide discounts were on volume and any updated commentary on that 2026 energy revenue potential.
The Megapack story.
The Megapack story. Beyond that, we'll be watching for roadmap updates on FSD, Dojo, and Optimus in early 2026. And on the macro side, any rate cuts would be a tailwind.
Of course. Let's maintain balance. We have to talk about the bear case, the risks.
Absolutely. The primary risk remains auto margin compression. That 16% gross margin figure is real, the price war is ongoing, and competition is fierce.
So that's the business cycle risk. What's the big high-stakes execution risk?
It's that the stock's premium valuation depends entirely on them successfully executing and commercializing FSD, robotaxis, and Optimus.
And that's not a given.
Not at all. Delays, or worse, regulatory setbacks, like increasing scrutiny on autonomy, that would significantly pressure the whole bullish case.
But the source material also notes that these risks they're known, they're increasingly priced in.
They are. The risks are material, but they're recognized. And the data advantage and early mover status still give them a credible path forward. Even partial success on any of these fronts could move the needle in a big way.
And then there's that speculative catalyst, the idea of future X Corp.
That is explicitly speculative, yes. The idea of intertwining the ventures, giving exposure to something like SpaceX.
A long shot.
A long shot, but it highlights the unique nature of the stock. The upside is asymmetric, The potential gains from the AI and robotics optionality are they're massive compared to the conventional auto cycle risks.
So bringing it all together, What does this all mean? The narrative seems clear. This is a multi-year investment looking out to 2030,
That's right.
where the upside is driven by realizing that optionality in energy, FSD, and robotics all layered on top of a still growing EV business.
And if we connect that to the bigger picture, the willingness of management to endure all this margin pain today, to generate the data they need for tomorrow's high-margin services,
Right.
it just suggests a really long game.
So the question for you, the investor, is,
The question for you is whether you're willing to underwrite that execution risk. Are you willing to take that chance for the asymmetric payoff of them becoming a true integrated AI, energy, and mobility platform?
that's a powerful thought to end on. If you want more in-depth analyses like this, make sure you hit that subscribe button.
Thank you for tuning in.